All right, a different way to look at these financial statements is a vertical analysis, which by definition here is up and down. What we're looking at here is we're looking at what percentage of any single component, what percentage any single component is of the total. So what I mean by that is if you're looking at this financial statement, you can see total assets are 1,139,500. Well, what percentage of that is current, meaning, available to you right away, able to turn to cash within a year? Well, it looks like about half of that, 48%, is current of total assets. So your total assets would be the 100%, and the question is any component, what percentage would they be of that? So property, plant, and equipment, 39% of your total assets are comprised of property, plant, and equipment. All right, there's nothing to say that any of these numbers are bad or good. That's not really the case. What you might do is you could look at these numbers and you look at them from year to year and say, well, how much have they changed and what has changed and why have they changed? The other thing you could do is often you can use these numbers to compare to competitors. Competitors would have their own financial statements, and you could compare to them. Well, we're General Mills and we're I can't think of another cereal company. I just bought cereal. General Mills and oh my goodness, I'll make up cereal names. Okay, so let's pretend we're General Mills and whoever makes Kellogg's. There we go. I was thinking whoever makes Frosted Flakes. All right, so we're General Mills and we're Kellogg's, and I might want to see, well, how does Kellogg's operate? Do they have lots of current assets? What does a successful company have? If you're comparing yourself to competitors, another thing you might do is you could use what's called benchmarking. Benchmarking is when you compare yourself to an overall average of other companies who do the same thing that you do. So if I'm getting into this, well, cereal's rather large, but we'll say it anyway. Say I'm getting into the cereal business. I might say to myself, well, Kellogg's is a highly profitable company, so what's their setup? What's their ratio of current assets to total assets? What do their current liabilities look like in comparison to their total liabilities and stockholders' equity? Okay, so and when I compare my own business to other people's businesses or the average of other people's businesses, it's called benchmarking. All right. So here we go. It's showing you that what you're doing is you're looking at current assets over total assets. That gives you that 48% there. All right. If you're looking at I think this is a pretty valuable tool. If you're looking at a vertical analysis from an income statement perspective, this is actually pretty helpful. I know for a fact that this is helpful because my husband ran his business looking at his income statements this way. What you're doing is you're saying what component is everything of net sales, right? Your net sales is your 100% number. You might say, well, why is not just regular sales the 100% number? Well, that's because these are the sales you made and these are the ones that got returned. So at the end of the day, this is the actual amount of sales that you had, $1,498,000, because people returned $32,000 worth of your products. So that's going to be our 100% number. Now the question here is, what percentage of our net sales was cost of goods sold? Well, it looks like 69% is our cost of goods sold. Our profit on every sale was about 30%. That's how you can look at it. For every dollar sold, 30 cents, 0.304 cents, let's just say 30 cents. 30 cents of that was profit. All right? So that's what you're looking at here. Well, last year, remember we talked about, I said that I would have been concerned that the cost of goods sold number went up so much. Well, last year our profit on every dollar sold was 31 cents, or almost 32. This year it's about 30 cents. Now that may not seem like a lot, but when you add a bunch of zeros to it, it will be. All right, so the other thing is, as I mentioned, selling expenses went up. All right, 12.8% rather than 12.3. They may not seem like a lot again, but you add some zeros and it does, it does make a difference. So this, I think, is a very useful tool to look at to look at these financial statements using this vertical analysis tool, because you can see how much you spent on certain things. Well, you spent 6.9%. You can look at these. I'm saying percentages, but if it's easier for you to think of it this way, you can think of these as cents. You could look at these as $1 or $100. Well, $1 I think is a little bit easier to get your head around. And you can say, well, 69 cents of that was cost of goods sold. 30% of that is gross profit. And from there, you can look at it that way. Well, from that 30% gross profit, now 12.8 cents went out to selling expenses, another 6.9 went to administrative expenses. All right, so you can really see how you're doing. The thing is, like I said before, is you're not looking at these in a bubble. You're not looking at just 1 year. It doesn't help you at all really to look at just 1 year. What helps you is look at comparatively from 1 year to another. That's how you can really see what the changes have been, and what things are going up when other things are going down. All right. This is financial analysis, so get it? You're analyzing. You're looking at these things. You're looking at these things and trying to understand what happened and seeing if everything makes sense. All right, the third tool is a common size statement. In a common size statement, we express them as percentages but no dollar amounts. And what this is useful for, and you'll see what I mean in a second with numbers, but what this is useful for is when you have, say, like before I was saying I was going to start up a cereal company. Well, clearly I'm not going to be Kellogg's, nothing as huge as Kellogg's anywhere in the near future. But if I still want to compare myself to Kellogg's, I'd be comparing my little $100,000 business to a $2 billion business. I mean, I'm making up the numbers, but you get the idea. So it's kind of hard to compare when you're so drastically different in size. So a way to use these financial tools in order to compare companies of different sizes are common size statements. And all we're doing now is we're looking at the percentages. We don't look at the individual numbers. The numbers will just throw us off because the companies could be such hugely different sizes. But if we look at percentages, this is where we can see how our company compares to one another, because the percentages have nothing to do with the dollar value. The percentages from our vertical analysis here, they have nothing to do with dollar value. They're all about what percentage of a whole. All right, so like how much profit overall did Lincoln Company make versus Madison Company. All right, so if I'm this little company and I'm trying to emulate a big company that I really, I admire or I want to follow in their footsteps, I can use common size statements in order to do that. All right, I'm going to stop this now only because we're going to start getting into the actual individual one-on-one ratios. All right, I'll see you on the next one.